So next, we are going to have a wonderful section. It's mainly on the macroeconomics. We have Mr. Deepak Mehra. So the section is going to be with the current market scenarios, how the dollar will be performing, how we have to invest, or whether we can go for equities or bonds or fixed deposits. Here we have Mr. Deepak Mehra. He is the head of investments at Commercial Bank of Dubai, and he is in his position since 2007, and where he has successfully launched the first robo-advisory in the region from a bank. In his banking career, spanning over 30 years, he was previously held the leadership positions in Citibank and Credit Suisse. He is a regular speaker on Bloomberg TV and himself as an author of the best-selling book, Ready, Steady, Go. And Deepak is in his workshop to launch his second books about the life lessons of golf. So I wish him all the best on the same. And Deepak is an engineer, graduate from IIT, and an MPA holder from Institute of Management Technology. I heartily welcome Deepak on stage.
Can you switch this on as well? Yeah, this is better. Okay, I have a 30-minute slot here. What I'll do is, increase the volume. Yeah, very good. Can you hear me now at the back? Thank you. So I have 30 minutes here. It's 12:50. We'll wind up by 1:20. And I don't want to be standing here between you and the lunch. I will finish my presentation in 20 minutes, and we'll keep 10 minutes for Q&A. And the Q&A is important because everyone sitting here is exposed to global macro. As a finance professional, you're worried about interest rates. You're worried about what's going to happen to US dollar. We live in a country which has a pegged currency. A stronger currency may be good, but may not be that good as well at times. What's going to happen to interest rates? What's going to happen with equities and bonds, and what about your personal investments other than what you do for your corporate? So we'll go very quickly on the presentation. These are simple things that I'm going to share with you. I like to look at history a lot because without looking back, we can hardly understand what's happening today or what's going to happen in the future. So let's go next slide, please. This one? Okay, excellent. These are the sort of things that we've been seeing in the press towards the end of the last month. These things haven't happened in the global markets since 2008. We had a complete collapse of the UK pension system. And by the way, UK pension system is 1.6 trillion sterling pounds. And we had margin calls on that system of about 175 billion pounds on one afternoon of 28th September 2022. Had Bank of England not stepped in, 3 of the major UK banks would have collapsed that afternoon. We haven't made too much of noise after that because it was very quickly covered up. And the government had to resign post that. This was not a Lehman moment, this was a mother of all Lehman moments had they not controlled it. We also had, a week before that, the Central Bank of Australia, the Reserve Bank of Australia, wiping out its complete equity and reserves, lifetime reserves, because of the losses on its bond books. We also had in the same week, 2 days between these two events, when Swiss National Bank, considered to be one of the safest countries from a financial strength perspective, drawing on emergency swap lines from US Federal Reserves to the extent of $11 billion in one day. Now these events remind us of what had happened in 2008 when after Bear Stearns and then Lehman Brothers happened, and after that the whole system just froze because no one was trusting anyone else. Now we may not understand, but we are very close to that. or we were very close to that, and we can still be very close to that. Because what happens is when interest rates go up as much as they have gone up now, and this is your 2022 chart, the world is not prepared for it. We have been living in a low interest rate environment, not just in the last 10, 15 years after the great financial crisis, but much longer than that. And when rates go up this way, everyone who has leverage or everyone who has borrowing gets exposed. Gets exposed because the return on your assets for which you borrowed are pretty much fixed and pretty much defined. But the cost of borrowing goes up and all your financial planning goes for a toss. So we cannot be very harsh on ourselves because we did not plan for it. Here I give you examples where central banks of the world did not plan for it. So be kind to yourself if you did not plan for higher interest rates in your company or for your personal investments. These are central banks collapsing or were about to collapse. We have to look back to what has happened this time around in interest rates. It has been a 40-year trend since 1982 when inflation went up to this level and the Federal Reserve had to step in and take the interest rates up to 20%. Since then, interest rates have been coming down. It's a 40-year cycle of lower highs and lower lows in interest rate. It was a very major trend. Many of the investment professionals around the world thought that they were fantastic investment gurus when everything was making money. And that process started 40 years ago. You didn't have to be a rocket scientist to make money. You invest in anything, equities, bonds, fixed income, real estate, private equity, alternatives, everything makes money because interest rates are going lower and lower. And actually, every time they used to raise the rates, they could not raise it to the previous peak. It used to be less than that and the economy would start cracking and they used to cut the rates very quickly. They were never able to hold rates anytime and always at lower levels. This time around, for the first time, we have broken that 40-year trend of lower lows and lower highs. And that is why you are seeing the crisis that we are going through right now in the asset market. By the way, $57 trillion of asset valuations have been wiped out just in the US alone. So this includes equities, fixed income, real estate, and so on. It's a massive drawdown from whatever levels we were seeing for all asset prices. This is the reason. Not only that, the increase of interest rates this time around has been the fastest ever that we have ever witnessed in the last 120 years. So look, the rates in 2022 here are going up straight line. The closest we went in this direction was in 88, 89, but that was very brief, and they had to cut rates immediately after that. But this time around, it seems the story is still going on. So this is part of the reason we have this crisis. And what is behind these interest rate increases? It's inflation. Now, inflation came back after COVID because one, there was pent-up demand. 2 years, people did not spend money, and in those 2 years, the government in the developed markets were giving money to people to just sit at home. And people, on an average in the US, got $300 per person per week. A family of 4 over 1.5 years accumulated $80,000 to $100,000, an amount which only 2% of the Americans had seen ever in their life before that. That is a sort of wealth which was passed on to people. So now, two things happen. One, we have a lot of accumulated savings. So when the economy started opening up, they started rushing out and spending, revenge spending. Second thing that happened is they saw reserves in their bank account they had never seen before or even dreamt of. So they don't want to work anymore, full time, 9 to 5. Sorry. This is an amount which we had only seen in American movies, $100,000, $80,000 lying in a bank account. Never seen by an average American, who used to always live on credit cards with a negative savings rate of about 2% for the last 20 years. So what they are doing now is the average Joe Bloke who used to work very hard from 9 to 5 now has bought a car of $10,000 to $15,000 or bought a bike of $5,000. Either he's become an Uber or DoorDash food delivery person, works for 3-4 hours a day, enough to run his household, manage his children and so on, or drives around, switches on his mobile app 3 hours in a day, takes some people around. Very happy, still has $80,000 in his bank account, so doesn't want to work. And so labor inflation is there, which is still causing a lot of problem. It's not as bad. I'm coming to the good side of it as well. So we saw inflation at the headline inflation at 8.2, which was only seen last time 40 years ago. And that is the same 40-year-old story that I told you here. It's the same 40-year-old story. So life was beautiful. A lot of low inflation environment is also a result of globalization. But what globalization does is it reduces the cost of doing business because you go looking for the cheapest resources available anywhere in the world. The prerequisite for globalization is peace, is global peace. Today, we have now come to a situation where peace is being questioned. So it's not that globalization is leading to deglobalization because we want to onshore everything. That is part of the problem that governments have realized. So onshoring, reshoring, friendshoring, all those things will happen. But they will still look for cheaper and cheaper alternatives. But if there is no peace, then you avoid cheaper alternatives and you still live with more expensive alternatives which are at home or closer home. So inflation is becoming very worrying. However, in the last 2 months, we have seen inflation dip a bit, and I'm coming to it. So 8.2% headline, never seen in 40 years. This low inflation period, by the way, also is a period when a lot of wealth was accumulated because, as I said, everything made money. So people have got used to making easy money. So that being used to making easy money, being used to borrowing cheap and investing in projects that give you good yields, those were the assumptions of the last 40 years are all getting questioned today. And I think those are the questions we need to ask as finance professionals and you as CFOs and managers and CEOs of companies. How would you allocate resources going forward? Important question to ask. World peace is being questioned. Globalization is being questioned. Now coming more to our personal balance sheets, we've seen both equities and bond markets perform very badly in the last, let's say, 9 months. And it has never happened before in the recent history that both equity markets and bond markets have gone down together in a single year. Equities and bonds are considered to be balancing factors. When you say balanced portfolio, you say I'll mix bonds with equities because when equities fall, bonds hold their value. So the same thing, the 40-year monkey throwing darts and making money period is over. And a rude wake-up call has come this year to us which has never happened in the past. So this is S&P returns. Whenever S&P fell, bonds always gave you a positive profit. This year, it's dramatic. First, we have never seen bonds fall by 15.8% year to date ever before. This is the worst bond performance from 1788. 1788, not 100 years. We are talking of 250 years. It has never happened that bonds have fallen so dramatically as they are falling for the reasons that we just discussed. So there is really nowhere to hide. There is no place to hide for an investor. And therefore that brings to question the entire premises on which wealth management industry has been set up and private banking and investments have been set up. Because a lot of people thought that they were really good investors, but they were not. It was the environment helping them. This is the rude awakening. So that's all the bad news. Now I'm trying to see what is the silver lining out of this. Are things improving or are we getting worse? The good news is things are improving. They are not as bad as they were. We have seen the US headline inflation that I showed you at 8.2% had peaked at 9.1%, and since then, in June, it has been coming down. And we'll cover the reasons why it has been coming down. So things are improving, and we can either give the credit to Fed that yes, higher interest rates are finally pinching people's pockets and they've stopped spending a bit. But we should also give credit to Fed that because of the great fall of equities and fixed income and everything in general, there is a negative wealth effect coming around the world. Especially so in the US, where a lot of this free money had been invested in things like cryptocurrencies and NFTs and meme stocks and stock market and everything else. Cryptocurrencies have wiped out about $2 trillion of wealth alone. Equity markets have wiped out a couple of $1 trillion on their own, just the US equities. And now we are seeing cracks appearing in the US housing market as well. So when you have negative wealth effect, people become a little cautious and they stop spending like crazy. So that revenge spending phase is getting over when you have negative wealth effect. And therefore we are seeing, and therefore that's the silver lining from this crazy 9 months that we've been through, which will probably help us to heal the economy once again. Why are these inflation pressures easing? So, well, I explained to you the broader thing, which is the negative wealth effect, but there are other data points that tell us that things are getting better. It's not as doom and gloom as we just saw before this. So we can see commodity prices. We'll quickly touch upon supply chains, rentals, and global growth. Why rentals? Because rentals constitute 34% of the US CPI data. Why is that important? Because if rentals stay high, CPI will stay high. CPI stays high, the Fed will keep the interest rates high. Fed keeps interest rate high, UAE central bank will keep the interest rates high. And Fed keeps interest rate high, US dollar will remain strong. US dollar remains strong means UAE dirham remains strong. And a strong UAE dirham and high interest rates both are a great risk to your business. These are a great risk to your business, both together. So, because we are a trading country, we are highly connected to the rest of the world. So strong currency and high interest rates both are a dampener to everyone's business sitting here in the room. But things are getting better, and that's what I'm trying to show here. So look at commodity prices. Many of you are in this business and must be following. What we can see is that from the war, this war is the Ukraine war time, which is February 2022. So I've covered industrial, which is essentially copper, aluminum, and so on. They are much lower than where they were before the war. If you look at agricultural commodities, I've just taken an example of wheat, but if you look at barley, corn, anything, they are lower than the level they were at the time of the war, when the war broke out. If you look at crude, that itself is lower than Feb end 2022. And natural gas, which is the biggest concern for Europe, has also come down to the same levels. This is the natural gas contract traded in the US market, where if you look at the Dutch contracts traded in Europe, which basically cover the European natural gas prices, they are below the pre-war level. So a lot of things have been solved. Why have natural gas prices come down? Because Europe has done eventually a good job in filling up their reserves, which are now 92% full. That doesn't mean that 92% full reserves can take care of all energy needs. Energy is still coming into Europe through US in a very big way. The US gas exporters are having a field time. And these reserves will be drawn during winters if the winter is severe. And if it is not severe, then happy days in any case. So all commodity prices have been coming down. They are also factoring in a slowdown in the global growth. They are also factoring in that China may never see the good days that it has seen in the past. Maybe the best days of China are behind it. It will take many, many years for China to reinvent itself from a very export-oriented economy to a domestically oriented economy where common prosperity and so on, so that the average Chinese, the poor Chinese also sees some benefit of China's rise. It will take them a decade, if not more. China is the second largest consumer of most of the commodities, and hence that's also getting reflected, because as developments are happening in China, they don't bode very well for growth in China. The second thing is about supply chain constraints, which was one of the biggest driver of inflation during COVID and just after COVID. Even that has sorted itself out. So there are no longer ships standing outside not getting unloaded or not getting loaded. So the Los Angeles, the San Francisco shipping, index, or the China-US index, or the Baltic dry index, you look at all shipping indices, they are telling you that the supply chain constraints are vanished. And we are back to where we were before the COVID issue. So that's also very good news. That means inflation should come down further in the goods space. The services inflation is a different story. Services inflation is linked to when the negative wealth effect makes people to go back and start working again. So that's the participation rate in the US, which has also started rising as people have lost money in everything from cryptos to equities and so on. But overall, so far so good. The most sticky part of CPI, which is 34% as I mentioned, is rentals, the cost of shelter. The government data that comes out, which gets published, comes with a lag. The private sector data, which is Apartments Limited or Zillow's, these are the two private companies in the US, that's already showing that the slowdown in the US housing market has started affecting the rental yields as well, the rentals as well. So as the rentals come down, and they have been coming down for two months now consecutively, the cost of living for people will go down further, inflation will go down further. So that's very good news as far as inflation is concerned. And finally, this is the Purchasing Managers Index, the PMI, which measures the sentiments of businessmen and business managers around the world. That tells us that, at the level of 50, we have neither contraction nor expansion. Above 50 is expansion, below 50 is contraction. We have been having a beautiful period all these years, except COVID, when both services and manufacturing, the green and the yellow lines cover both services and manufacturing, collapsed. And then there was a rebound, which we've discussed, and now another slowdown has started. And that slowdown has started for all the reasons that we've discussed. But it has not collapsed. It has not gone down below the expansion territory. It is still expanding. And that is why in the US, you know that there were 2 consecutive quarters of contraction of GDP, but they did not call it a recession because the labor market has been very strong. The corporate profitability, at least in the first 6 months of this year, has been very strong and so on. Even in Europe, where we have all this crisis, we have not seen the PMIs dip dramatically below 50, which means industrial activity, services activity is still continuing, which means energy is still available, which means people are still willing to work. The government is going to invest in a new industrial policy in many of the countries. So we're not seeing a collapse, even though there is a slowdown coming. So slowdown is important because we want inflation easing. Collapse is not coming. We don't expect, our base case is that we don't expect a severe recession in US at all. If at all, there could be a technical recession once again, like we saw in the first 6 months of this year. In Europe, we will have a recession, definitely, but with easier fiscal policies this time around. Central banks have done what they could do. The monetary policy has been used to the hilt. This time, now the next phase will be when fiscal policy supports the economy. So government will have to spend more, and there will be more policy actions, most likely industrial policy actions, because the developed world has to start generating jobs once again. They have to start manufacturing in their countries once again. So no longer can they outsource the dirty job to China and to emerging markets. They want it closer home. They want it at home. So same with Europe. I think it was a rude awakening that all of European growth over the last 40 years has been essentially thanks to dirt cheap gas prices from Russia. So that regime is over. And there is a marked change in policy required in Europe if they have to continue to grow, which is a very big challenge. Now, so there are two things we discussed. The first part we discussed how bad the things are from historic perspective. The second part we discussed how things are looking better. The third part is, despite all this, investors in general around the world are in a panic stage, in a panic mode. And when I say investors, it's individuals, it is corporates and everyone. Everyone is holding cash. But this is just one example which tells you how much of cash mutual funds are holding in their portfolios and not investing. This level that we are today, this is May 2022, it's a little more. This data is 4 or 5 months old. This was never seen. The last it was seen at this level was when we had terrorist attacks in 2001, when there was panic and everyone just started holding cash. So since then, we have never seen those levels of cash. So it tells us, in general, investors are in a panic mode. And if you are an investor, look at your own portfolio. If you invest in equities or bonds or whatever you do, you are trying to keep more cash with you and you are worried about what the world is coming out to. That is a fact. However, this is an interesting slide. We'll take a minute to discuss it. When you look at the companies themselves and the CEOs of companies who are going around saying the world is in a bad stage, we're going to lay off people, we are worried about recession, we are not going to be hiring anymore, and all the doom and gloom around, what are they doing with their money? They are going into the stock market and buying back their own equities. The level of buyback of stocks, which is expected this year, is a record ever. So what happens in the US is many large companies every year announce that, we have lots of profit. Some of it will be given in dividends, some will be kept in reserve. What do we do with the rest? We go buy back our own stocks. By buying back your own stocks, you cancel a part of your stocks, your earnings per share suddenly rises because number of shares outstanding reduces. So while all the doom and gloom is happening, the corporate America is buying back this year about $1.3 trillion of their own stocks back, which is a record only seen last year, which was the same situation where companies were doing extremely well, the stock market was falling, and companies said there is no better time to buy back our own stocks at such cheap levels. So you've seen in the US recently when Meta has announced, they say our stock is down 70%. Meta makes $69 billion of free cash flow every year. Meta has $69 billion of free cash flow every year. This is from Facebook and Instagram. All the ads, $5, $3 that people spend. 69 billion free cash flow. What do they do with the money? They go buy back their own stocks, and now the stock is 70% cheaper. But investors are worried. They are still dumping the stock. The company is buying back its own stock. So these are the things. In India, Infosys has announced a stock buyback. Why? Because Infosys knows that the stock is down. All IT stocks are down in the US, in India, just like the US. And Infosys is wondering whether I should return all the money to shareholders as dividend, or why don't I go buy my own stock back, reduce the number of shares outstanding, and that way create more wealth for the shareholders. So this is really where actions speak louder than words, and this is what as investors we have to understand. When you have a market that has dropped 25%, which does not happen very often, and when all asset prices are dropping, and when fear grips everyone, probably the best time for the smart money is to go back and start investing once again. Now this is not just for equities, this is for everything, whatever business you do. And that lesson came from a very smart investor, Jeremy Grantham. Jeremy Grantham is the co-founder of GMO. Old man, you will see him on Bloomberg and CNBC very often. And he did a study from 1925 onwards, and he was talking about this, from which I just made this pie chart when I saw his interview. He said, look, from 1925 to now, of all the times that we've been in the market, 85% of the times are normal times. Normal times means there's a bull market, bear market, good times, bad times, things are fine. 12% of the times when extreme greed sets in, it is irrational exuberance comes in, which was the time just after COVID, when people were buying anything. They were not happy buying bonds and stocks. They were buying cryptocurrencies. They were buying NFTs. They were buying meme stocks, which were making losses all their lives, which had no cash flow, no business. So that's extreme greed, where you have concepts like FOMO sets in, fear of missing out, and you just start buying anything and everything. Private equity does well in those periods, and anything does well. And there is only 3% of the times in the history where extreme fear comes in. You know that we are guided by fear and greed in terms of our sentiment. So it's only 3% of the times that extreme fear sets in, and that extreme fear we have seen just when COVID struck, when people were selling, when the markets were down 35%, they still wanted to sell stocks. 2008, when markets were down 50%, people still wanted to sell stocks. UAE markets were down 72% and there was not a single buyer in the equity markets. Property prices were down 40 and 50% in Dubai, not a single transaction happening. Extreme fear. But that time only lasts for 3%. So people who can ride those times always benefit, because the rest of the 97% of the times, you're actually making money. Now this does not just hold true for equities, because we are, as humans, driven by our own fears and greeds. This holds true for any business. This holds true for any investment. It's a project investment, corporate investments, deploying your money for some new venture, real estate, bonds, and you name it, name anything. The same human psychology of greed and fear plays out, but the interesting part is, if you can live through the 3% of the fear, everything else takes over. Thank you very much. I'm done. And I still have maybe 1 or 2 minutes left. Maybe I took longer than what I should have. If there are any questions, I'm happy to address. Please. Yes. Okay, so the question is, when do we see interest rates going down again? I will show you something here. We go back to studying history, because only history can tell us about future. What this tells us is that every time interest rates have gone up, they have been cut very quickly, because the world cannot live with high interest rates. You can see peaks, and immediately they start cutting. Recently we saw in 2018 they were increasing rates. Much before COVID, they had started cutting rates, because the economy stalled at 2.5% interest rates here. The only time they kept rates very high was during the boom period, late 90s, when the rates were increased and kept high for a while, for almost 5 years before they were cut. Now, where are we in the situation? I think the inflation story is easing, as we saw. However, the Fed is very conscious that they don't want a 1980-82 scenario where they cut rates and had to increase rates all the way to 20% after that. So they left their job half done. So it will be more like, the shower in the hotel, new hotel, any hotel you go, you are trying to figure out hot water, cold water. Suddenly you get a lot of cold water, now you want hot. And then when you turn it on the other one, you suddenly start burning, because the hot water starts. We go on extremes. It is very difficult to calibrate. At your home you can do it, but in a hotel you can't. So the Fed is in the same situation. Doesn't know when to stop. It is likely to err on the side of caution rather than err on the side of the market. That's what we understand, which means the rate may not be cut, but the rates may stay on hold, and that hold may come as early as January. You can see Bank of Canada, Central Bank of Canada, and you can see in New Zealand and ECB. All were expected to raise rates by 75 basis points, they raised it only by 50 basis points. So a soft pivot is coming. But that doesn't mean rates will be cut soon. Absolutely. So anytime Fed pivots, if it stops increasing rates, you will see a phenomenal rally in equities and bonds. What we are seeing right now is a generational opportunity to buy high quality companies in the US and some other parts of the world. I'm not talking about UAE because this market is in a sweet spot. UAE markets have not participated in the downward equity movements at all. We are still moving up because we are counter-cyclical and we are benefiting from a counter-cyclical play. But the US markets will see a phenomenal recovery when Fed pauses. And that pause is coming sooner than later.
In the interest of time, we'll just take one more question, please.
Sir, I have a question. See, you have mentioned that since we are a trading nation and
Yes.
since the interest rate is going up and US dollar stays strong, it's a dangerous period. So if you look at the geopolitical scenarios emerging, Europe before the war, they were taking around 10% of their total fuel and natural gas from the Middle East. Now that has gone up to 20%. And this has a financial impact of around 3.5 trillion US dollar coming into the coffers of Middle East government. So if a fraction of that just comes back into the market by way of government spending, I mean, it's not a dangerous period. It's going to be a great period of opportunity, isn't it? Is that correct or?
100% correct. So there are two ways to look at it: the government balance sheet and your personal balance sheet and your corporate balance sheet. The government balance sheets in GCC have never had better than this. You know why? Because after the 2008 crisis and even after 2011 and so on, the governments in GCC have been rationalizing their spending and they become very efficient in spending money, which has the most impact. So rather than giving subsidies in general, they become very focused in subsidies and very focused in spending in areas which has a multiplier effect. So a lot of discipline in spending has come. So therefore, whenever oil and gas prices go up like they're going up here, the sovereign wealth funds and the surpluses go through the roof. Now that does help in increasing government investments, and then you're right, it trickles down to everyone. However, that is a trickle-down effect that takes time, whereas your balance sheet is attacked immediately when there is high interest rate and strong dollar. So that is a risk that we should be conscious of. If you still think that in that 40-year period when everyone made money is what is going to come back, unlikely. Because we have serious risk to world peace and therefore serious risk to globalization. So even though the government coffers will be full and better than ever before, and the government is going to be very disciplined in spending that money, and they are also very conscious that they have to keep the coffers full. Coffers are not to be spent. Your balance sheet is vulnerable. So that was my point.
Last question.
Hi. Thank you so much, sir, for your information. I just have one doubt. Recently, we have seen LIBOR moving upwards quite fast. There's a gap between LIBOR and the Euribor and the EBOR currently in UAE. It used to be on the other side, but this time there's a negative one. Is it cheaper to borrow in UAE right now?
Yeah, that's a very good observation. What has happened is that 3-month LIBOR, 6-month LIBORs are moving up because interest rates are being increased. And in tandem, the 3-month, 6-month EBOR is also moving up because average interbank rate is pegged to the US dollar. But we are seeing a peculiar phenomena this time, only with UAE, not with Saudi and others, that our EBOR, our interbank rates are trending lower than US interbank rates, US LIBORs. It's only in the UAE. The SIBOR in Saudi Arabia is more expensive than EBOR, but in UAE, EBOR is trading lower than LIBOR. Why? So local interest rates, one, they are pegged to the US dollar, but the LIBOR is guided by another factor, which is liquidity in the market. UAE has become a safe haven for the world. I said it is counter-cyclical, but it is also a safe haven. The amount of liquidity coming into UAE from different parts of the world for different reasons is just phenomenal, never seen before. Banks are flush with liquidity, and more is coming. Partly driven by geopolitical risks in certain parts of the world, and partly driven by the diversification and the investment opportunities we've created. in the UAE. So as a result of high liquidity, the interbank rates in UAE are low compared to dollar rates. This situation is likely to persist because we have not done with. We are very, very attractive, and geopolitical risks are not over yet. We will continue to be a beneficiary of liquidity, global liquidity. In fact, we have entered into a situation where we become like a Switzerland of the world during World War. Safe haven. Everyone just rushed to Switzerland to keep their money, and they said, okay, keep Switzerland safe. But around it, there was crisis. We become that sort of a safe haven. So is it cheaper to borrow in dirhams? Today it is. Is it likely to continue? Probably it will. And my hypothesis is that rates will probably stay high, for some time in 2023, at least for three quarters in 2023 before they start cutting. And so therefore we should prepare for it. But yeah, borrowing in dirhams is cheaper right now. If I have a 7-year borrowing, will I do it in dirhams or dollars? I would still do it in dollars because I am not sure that how we will manage this excess liquidity and what will that lead to? Will it lead to high inflation in UAE? And would that be beneficial or would that hold us back? So those are the things we'll worry about, but not now.
Thank you. Sir, on behalf of ICAI Abu Dhabi Chapter, we would like to thank you for an excellent presentation.
Thank you so much.
Thank you for covering all the critical aspects of inflation, interest rate, and its impact on global macroeconomics. Thank you so much.
Thank you very much. I really enjoyed, and I hope you all benefited.
May I please call upon Mr. Neeraj, our past chairman, and YK Gupta from Bank of Baroda for the memento, please.
Very nice. Thank you very much. Good to see you again. Thank you so much.